This is part two of the, excuse me, part two of the essence of project finance. And it's really almost part of the first chapter, but I thought it's worthwhile going through this subject a little more deeply and working through the contrast between project finance and corporate finance. My theme is that the project finance should be the foundation of corporate finance in a long-term future world. Corporations should report their performance on a project-by-project basis so you can evaluate the value of these corporations through looking at the runoff, the completion of existing projects, the cash flow from existing projects, and the risk associated with that cash flow, as well as the potential for earning an economic profit. Unfortunately, that's what everybody wants on new investments. That's how we could really value, in theory, a corporation. And then once you understand that basis for valuing a corporation, you can see what are some of the problems with valuation techniques, including WACC, risk changings, accounting measurements of return, and appropriate adjustments for debt in the analysis of risk. Okay, so now before I get started, I had a long couple of weeks where I was kind of staying at nice little inexpensive hotels. But if I work on Excel, the one thing I like is a good chair. So I'm going to just give you a little, this is kind of off the subject, but a little discussion by George Orwell of environmental issues, such as the problems with motor cars and television, which at that time was radio, and the benefits of sitting in a comfortable chair and doing Excel.
Good evening, George Orwell.
Bonsoir, George Orwell.
Perhaps we should start with you telling us.
Peut-être devrions-nous commencer par vous laisser nous parler de vous.
I like English cookery.
J'aime la cuisine anglaise,
English beer,
la bière anglaise,
French red wine,
le vin rouge
Spanish
français,
white wine,
le vin blanc espagnol,
Indian tea,
le thé indien,
strong tobacco,
le tabac fort,
coal fires,
le feu de charbon,
candlelight, and comfortable
la
chairs.
lumière des bougies et les chaises confortables.
I dislike big
Je n'aime
towns,
pas les grandes villes,
noise,
le bruit,
the motor car,
l'automobile,
the radio,
la radio,
tinned food and
les conserves
central
et
heating,
le chauffage central
and modern furniture.
et les meubles modernes.
All right, so let's begin. I'm a little bit repeating myself, but if we really wanted to value a corporation, we would understand that a corporation is just a set of projects, whether it's a little Dunkin' Donuts shop, I don't know, who knows how they're franchised, sorry about that, or a company that holds a large portfolio of solar investments, some of which are being constructed, some of which are being developed, some of which are operating and leading a boring life, okay? When we look at corporate finance, we see that we cannot really understand and take account of the fact that projects are just a corporation is a set of projects. Now I try to apply this to other things, and this is a kind of silly illustration. Detroit, Michigan in the U.S., the Renaissance Center, some baseball field or football field or something, some apartment buildings, some whatever, MGM Grand. Those we can pretend are all projects, and we can pretend the city of Detroit, the value of the city of Detroit, which was bankrupt when I took this picture, they consist of the value of individual pieces of the puzzle. Maybe that's not such a good one. Maybe this is a little bit better, but think of the value of a family. Maybe it will die out. And we think of, I'll try to keep going. We think of the value of a company as the value of these individuals in the company. They're each at a different stage in their life. Some are old, some are finished with their productive time in their life, just siphoning away from others. Some are young and extremely risky, being teenagers, and some are just at the height of their value, just with a lot of future value potential and whatever. So that's, you think of a corporation, of a portfolio of projects with different risks, with different lives. That's the point. Now, this is a slide I made a while ago. And when I first made this slide, I said, well, let's look at the first thing. Where'd you get information for valuing? And for project finance, I say, we get our information. No, for corporate finance, we have this set of history, financial statements. That's our history. We can look at trends. We can decipher the financial information. We can look at the notes. We can look at the cash flow that has been produced by this corporation and try to assess some value. Whereas with, project finance, we have no history. Oh no. So what we have to do is either look at something like a resource study with a P90, P50, blah, 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 or perhaps some contracts that have been signed, and then we assess the viability of those contracts. We'll work through some case studies, of course, on this. And that made me think, well, okay. On that check mark, maybe if you maybe this is interesting for me, maybe we say, who's the winner? Who's the winner? Project finance, corporate finance. And I think a lot of people might say for this one, corporate finance. They're the winner because we have all this history. And my response is going to be absolutely not. Okay? Because of distortions with depreciation, because of distortions with things like write-offs. We can't really find the rate of return that we're looking for, this famous IRR that we care about and that allowed Mr. Bezos to pay his wife or ex-wife $38 billion. Now let's turn to financing. Well, we know the bank assesses the project and whether the project's going to work. And we said without our big debt financing, the project's not viable. That's our big test. When you really think about corporate finance, and you study not, companies that are doing all well, but you study companies that are going bankrupt or have gone bankrupt. I looked at a company named Sun Edison, and who was originally a solar manufacturer. That a lot of those people went out of business. What made the bank? What was the problem? What made that go bankrupt? It's not the DSCR we talked about. It's the fact that the banks lost confidence in the company, and it was a very kind of funny thing. They could look at some ratios, but ratios like debt to EBITDA or something like that, but or even debt to capital, which is much less meaningful. But there wasn't a default like we have in project finance. So on this one, I think project finance wins. Now, how do we assess kind of the value of a project? Well, in project finance, we basically look at the cash flows, classic NPV, but the discount rate we use is the IRR that other people would use if they were buying this project. For valuing a corporation, this is where we get the unbelievable, horrible terminal value, where we have to make some sort of assumption about the project lasting forever and ever. Maybe you can say, well, that project finance doesn't help because we have to guess what kind of new projects will be made. For corporate finance, the big problem in information really is what kind of CapEx will it take to have the company growing. And then, as I've already mentioned, we focus on IRR and DSCR, okay, PLCR, LLCR, maybe even average debt life. In corporate finance, return on invested capital, PE ratios that everybody looks at, EV to EBITDA ratios, debt to EBITDA, aren't those good? Well, I'm going to try to say that project finance really wins on all of these, okay? And my big problem is that corporate finance is a little bit like some magic potion. And I think I'm going to stop here and we'll take a little Excel break. And that's what I try to do in my classes. And I will try to evaluate corporate finance and project finance from the standpoint of return on invested capital. Now, when I talk about this, I talk about McKinsey and their big deal that all of corporate finance is centered around return on invested capital and whether return on invested capital exceeds the weighted average cost of capital. And if you have benefits exceeding the cost, you should grow. And that's the only three variables. We have return on invested capital, weighted average cost of capital, and growth. And let's look at, again, I'm not going to go to the website here because I did that in the last video. I hope that if you're watching this one, you might have seen the other one. Well, that was the file is in courses, and I think it's called Project Finance Theory. You'll find that at the website, edbodmer.com. An arrogant kind of way to do this. So we set up a little example earlier where we have some cash flow, we have some CapEx, and we have a project IRR. Okay? That's what we set up, and then we even put some debt into this little example, and we put a 20-year debt, 5% interest rate, which led to the debt service using the PMT formula, and we put a little flag to make sure and turn off this debt service after the tenor of the debt is complete tenure. Okay, and then that gives us our dividends, and we take the amount we spend for the equity versus the equity cash flow from the dividends, and that gives us our equity rate of return, our growth rate, if we invest the same amount of money, and then we did that. Now, let's talk about return on invested capital. In corporate finance, we don't look at cash flow, really. We depreciate the cash flow and look at our EBIT. You can call that net operating profit, or you could put taxes in here and call that NOPAT, net operating profit after tax, if you want. And then you make a little balance sheet. And I didn't bother putting the debt and equity side of the balance sheet in. I just put the gross assets in. And we depreciate the assets typically over a straight line basis. And that's our problem. We've got 30 years of straight line. Oh, you saw the secret graph. So this would be our gross PP&E or something. We probably wouldn't even see it on the balance sheet. We accumulate the depreciation by going back 1 year, and then we have our net investment. They're kind of net assets. A balance sheet for project finance would not look so different than this. You might have some debt service reserve account, maybe, probably not. Maybe it's just a liability, maybe. Not much else, frankly, okay? And then we can compute the return on invested capital. Whenever you do this, if you're making a little example, you take the current year, which is our EBITDA minus this, gives us our NOPLAT. We divide it by the prior period's investment, and then you get this thing. You get these returns that are low. And that's the big deal. And I mentioned in a way earlier a video that the analysts, the stock analysts, were going after Shell. You jerk, you idiot. You get such low returns. And I think it's very clear that the kind of stock analysts focus on this return on invested capital. Why are you getting such low returns? And if we're making major investments, the returns are low, 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 but then the investment goes down. And as the investment goes down and the EBIT stays the same because of, very simple, but sometimes that's the best way to show this, because the investment goes down and down and down and down here and down, and the return stays the same, the return on investment goes up. Is that so complicated? And then I make a graph of that return on investment, which is lower than the IRR at first, higher later on. Now, if you would compute a weighted average return and take this investment and compute the net present value of this investment and compute that net present value and do a weighting. So the net present value of this investment way over here is really, really small, and you weight this return at this NPV of the net investment, you would get exactly the same as the IRR. Okay? But you can do something else. Now, it took me a while here, but if you use the IRR, in this case the project IRR, and in all cases the project IRR, except maybe if you have some taxes, but let's put that aside for now. You take the NPV at the project IRR, and you say, well, that NPV here of the future cash flow, notice it's the next period's cash flow, not this period's cash flow, the very first one, because the NPV equals the IRR, and we had all that discussion in the last video, that NPV goes down, and then we just keep doing that again and again and again. And then we say, well, here's what depreciation really is. It's the change in the value of the asset. And if you value the asset at the IRR, you take the last period versus this period, and if I compute shift control V, that gives me my sum, and it goes all the way to the end, and don't complain about that. And that's just because generic macros was open. Then you can get the earnings before tax, EBITDA, minus this economic depreciation, which is the change in the value of the asset. Maybe I'm not going to put this here. Okay? And then we take the return, just like we did up here when we computed the return, we compute that as the net investment. And usually what happens in my classes, I go through this, and kind of everybody says, so what? But the big deal, the number one deal to understand is now the return on invested capital is the same as the IRR. Oh no, I didn't mean to do that. Is the same as the IRR in this whole thing. So here's what this means. It means when you go and and try to value a corporation, this return on investment means nothing. Can you imagine if you had a company that was on the decline, maybe GE or somebody, and they're just not reinvesting their capex? Well, then they're going to have a return, a high return, because all their assets are in the older stage of their life. If you've got Amazon, who's putting all that money in those carbon-producing trucks all over the place, and they're making big investments right now where their investments vastly exceed the depreciation. I don't know if I just said depreciation before, but they're growing their assets in a big way, and then they're going to have a lower return just from accounting. So this business that we can use all of the historic information in corporate finance is kind of not very good. Now, here's what, notice me kind of getting nervous. Let's say, here's a problem with IRR. If we have somebody really screwed up in year 3, so the EBITDA was supposed to be 100 and some manager just couldn't clean the panels, whatever. He just let things go really badly, or the cost went up because he kept on taking trips to Singapore and staying in those expensive hotels. I don't know why you'd even enjoy that, but whatever. That's what he did, okay? Or he took cruises and just burned all this carbon with his cruises when he went on a Disney cruise. Oh, okay. And then how would you say, well, okay, we're going to make a report to our management about asset management, about what the value of this company is, or you could even imagine presenting this to investors. And you can say, oh, no, well, everything will get back to normal in the next year, and then our IRR on our investment, instead of 6.54, is 6.24, because everything will come back to normal. The problem with that is we have to then make a forecast, and is that forecast legitimate anymore? We have to make a whole revised forecast to get our IRR, and you can say in project finance, no, here's a big problem in project finance versus corporate finance is that we don't have a good performance measure, then you can just assume that this continues and get a really low IRR. Oh, what to do? Well, here's what we could do, and I hope, I wish people who are really doing some financing assessment and thinking about what the prospects for the company are, we can make in our financial report when our people want to value our assets. We could say, well, in this period, we take our 50, and then we put the same economic depreciation, which is the change in the value of the asset, and we don't have to change anything about the cash flows to get a new, unless we want to take some kind of impairment, but that would be a mess anyway. And then we say, okay, well, our EBIT went way down in this period. And yes. And then this is it in the next period, and then we take that EBIT, which is NOPAT and all that stuff, and then we compute our new rate of return, which is based on and that investment. Remember, this investment that we're using as a basis, that's the NPV of the future cash flows at the IRR itself. It's kind of like an accounting thing almost. And then you can say this performance was so bad, it was 2.6. And we can somehow try to make an assessment then of whether this is going to be the future return on the assets, or are we going to get back to this one? And we can say just how badly, we have a benchmark to see just how badly things were. And then I tried an alternative one when I went down and up, and I could even take the difference between this number and the IRR and say we're going to give a penalty. And that could be in a contract or something else. We can figure out a penalty or an incentive in a contract based on the difference between the IRR and the ROIC. IRR is the 6.54%. We take that number and multiply it by the prior period investment, and we get how much this manager has lost, which of course you could have done just by subtracting the actual from the expected ROIC. So that's a little bit deeper into IRR and how we think about investments. Now, the sad part about this is I've been saying this for so many years, and I think nobody's ever paid much attention to it. Okay, well, whatever. But it does show, if nothing else, that we have kind of a problem with measuring returns for corporate finance, if nothing else. Now, here's what I think some people do in project finance. I know this because I've seen it. And here, what you could do, let's say this is an energy project. You could find kind of boring utility companies, and depending, and the beta could be all screwed up for that. I've made other videos talking about this horrible, disgusting, making you throw up mean reversion assumption about betas. I almost won that in a case. I don't think I did, but whatever. At least it got mentioned. And then they take the debt to capital at the book value, but no. These companies have a market to book, a price to book of 2 times, so the debt to the market value is only 37%. And that's what they might do. And then they apply a really simple kind of formula that says the beta on debt times debt plus the beta on equity times the equity capital, debt to capital. That's what beta on assets is. We go back to beta on equity, and beta on equity is the beta on assets minus the beta on debt divided by the equity. Now, I've had all this discussion. The beta on debt, some people put that in these days. What a joke. What a joke. There is clearly a risk premium people earn on debt, so there's like, that's what you say. There must be a beta on debt so you can back it in, but of course there's no correlation between this business of standard deviations and getting rid of the independent variation and getting left with the standard deviation that's common to everybody, which is what beta is from. It's a little bit of a bad way to explain this, but so I put 0 beta. We put 0 beta in, and then we get an asset beta. The asset beta is to get the asset beta 37%. Where's the asset beta? Okay, and we put no debt, and we take the beta on the equity, which was 0.6, times the equity to capital, which is 1 minus the 37%. Sorry about messing that up a little bit. And then we re-lever, and we say, we got project finance, and we get 80% debt or something like this. And we put the debt to capital of 80%, and when we get that, we get a re-levered beta of 1.86 because of all that. And then we compute our cost of CAPM model, which is the risk-free rate plus the beta times the equity market risk premium. We use Damador, whatever, his ridiculous number here, times 1.86 plus a risk-free rate, which must be the risk-free rate that I just looked at, and we get 14%. We put 14% in, and it's good, it's only 20%, so it isn't a big factor, but we get a overall return requirement, a WACC, weighted average cost of capital of 7.21, versus if we do this the way people really do it, which is just kind of to take the cost of debt and increase it a little, we get a different cost of capital, and that cost of capital is not some trivial amount. It's 55% difference, and if you have an asset that's basically all capital, like solar, wind, or whatever, nuclear, so much of that is capital. This increase in the weighted average cost of capital is enormous. It's enormous. And if we do this, we're destroying project finance, totally destroying project finance if we think we need this kind of return instead of this kind of return. And then, so that's the, whatever, the next part of the analysis. And then we recognize that WACC makes no sense at all. This is my little diagram that somebody in my house doesn't like very well. We have a dating period where we think about probabilities and risks. And here's this woman doesn't seem to be enjoying this man very much, and they're on their phone, and they'll probably not have a second date. And then if you switch from thinking about a relationship to thinking about a project. And in a project, you have a development period. And you think about making your solar project, bidding on your solar project, making some kind of other project based on a commodity, going all the way to getting the money from the bank, going all the way to getting an EPC, engineering, procurement, and construction contract, everything, and seeing if it can be viable. The chances of this stage becoming a successful kind of long-term project is extremely low. So the risk is really high. The risk of spending money on this dinner is really high. But let's assume that for some reason they get along. And they get to the engagement date. I call this like a commitment fee from is that an engagement ring? I guess, I don't know. From a man's perspective. Okay, that's our financial close. That's when we make all our promises. I'm gonna love you forever and ever. Okay, whatever. That's like a contract where we make a promise. I'm never gonna look at another person again. Oh no, everything's gonna be perfect. Let's sign all these contracts. Okay, that's why I put it a little bit red. I modified this. You make promises that you're probably not gonna keep. And then you start paying money. Oh, your parents pay for the wedding. That's like the debt, putting money in somebody, you use somebody else's money. Well, it would be nice if you paid off your parents. That's not gonna happen with me, at least. And then you have your wonderful wedding date. This is my friend from Korea. In his Skype thing, he sent me this. That's very nice that he put that in. I wonder if he still has it in. That's your wedding date. And everything changes. Then you can see if the project's going to really work. And you have no idea if it was going to work beforehand. But that's like every corporate finance. Everything in corporate finance. Some projects you probably have a pretty good idea of. Others you don't. And you do a lot of analysis to see if these projects are going to work, but you really don't know. And then you have some historic financial data, and you get to about year 4. And when you get to year 4, you say, two things. This really sucks, this marriage. I want out. What did I do? Or you say, I shouldn't have yelled like that. Or you say, this is great. And if it's pretty good, then you live a boring life, have grandchildren, and then you die. That's a project finance. But that's any investment. That's the foundation of all finance. To say that we have the same risk here as here, as here, as here, as here is so ridiculous. How can you put the same weighted average cost of capital in your analysis? So because of the change in the cost of capital, just a minute. Okay, I'm just got to talk about this. Because of the change in the cost of capital, investors have some upsides. As the risk goes down, the value goes up. Now, of course, because of risk, we might never make it through here. But if we make it all the way, we've got upsides. 2 of the most obvious and clear upsides are, number 1, refinancing, and number 2, selling the project to a different investor. Now, even if you don't sell it, your value goes up as your risks go down. There are these things called yield co's. which really, there's all this fancy stuff about yield codes. I should go back and really study kind of what investors say about the yield code. Things like NextEra, this really big company, which used to be a Florida utility company, has a yield code. All these companies, what they do is when the assets get to be about 4 years old, maybe a little younger, maybe a little older, they put them in a separate subsidiary company, and they establish the value of that company. They own the majority of that company, but they can prove that the value of their assets has gone up. So that's a pretty creative thing to do. And so let's show you how that would work in Excel, perhaps. The first thing I want to show you, though, is I took the S&P 500. Now, if you go to the finance.yahoo website and you try to download it into just an Excel, you can't. But you can do a little trick, and I've got a file on my website called Betas, and it shows you how to kind of go and get the data. But they have the data all the way back through let's press alternate, all the way back through 1927, and this looks like the 2000 bubble, and then the 2008 bubble, a little bit of a hiccup on the way, the COVID down and back up, and all very good, and we've got kind of a gigantic increase in your value over a long period of time. But here's what you can do, and the idea here, is to demonstrate that while project finance has some upside because of declining risk, regular old stocks don't have the same sort of upside. So what you do is you put LN, that's taking the percent change from month to month. You notice these are monthly returns. You can get these for weekly or even daily returns from finance.yahoo. If you're tricky, it's just absolutely amazing, really. Okay, but monthly is pretty good here. So you get the monthly returns for all of these things. Sometimes it went up, sometimes it went down, and then on average, the average return in this whole period for monthly return was 0.49%, which gives you 6% over this long period. Now, this return is a little distorted. It doesn't even include dividends. So I'm not sure if it's even, you could say that's not even correct. But that 6%, but that's maybe the cost of debt probably was at least 3%, the kind of interest rate. So it's giving you a market premium of about 3%, okay? Then you can compute the standard deviation, and you can count how many observations you have. You can also make the minimum and the maximum, and then once you have the minimum and the maximum, you can take the difference between the minimum and the maximum, divide it by about, I put 100 little bins in here, 100 little bins. And once you put the 100 little bins in, you take an increment, and you have to remember to subtract 1 from the bottom, because I always have to do that. You start with the minimum, add the increment, and you get all the way down to the maximum. And then you use you press equal frequency. Okay, I'm doing a little more Excel than I really wanted to do. And you click on the entire return, and you click on the entire bins, and you press Shift, Control, Enter, and it gives you how many times we hit that minimum, and then where was the next one, and then suddenly we get a whole bunch of observations. Suddenly we get all of this, and the biggest seems to be right around here, where the monthly return was about, that's pretty good, about 1%, or here it was about 0. We got a lot when it's a little bit down, and then we have kind of a little bit of a frequency distribution. Let's kind of look maybe from here, and we can press whatever, alternate and F1, and that's kind of our distribution. And then what we can do next is divide these numbers by the total amount. The total we have 1,153 months. But then we can take a normal distribution. This is wonderful in Excel, where we can put this X value. This is the X value, and then we can put the average and the standard deviation in, and then we can say, no, let's not use a cumulative. Let's use a incremental, and then when you do that, it never works. You get 144.228, but then you can convert that to a probability. Oh no, I just repeated that. The normal distribution would be to take this divided by that 144, and then once you do that, you can select these three things, and you press alternate F1, and you get the distribution. And the reason I'm showing you this and going crazy with you on this is to say that's going to be we're going to explain in subsequent videos exactly how this works. Essentially, you have a, if not perfect, it's maybe okay, whatever. It's certainly not exactly normal. And there's all these complaints and these very extreme values. You call this the black swans and all that wonderful stuff. Taleb, I love some of his quotes, but on and on and on about the fact that it's not normal. Okay, good. But it's kind of symmetrical. We got a really extreme high one, a really extreme low one. It's symmetrical. Project finance would be, you kind of go down and you'd have this skewed distribution where you have a much more skewed tail. Because of the upside from the risk going down. And to illustrate the last one, let's go back to our project finance. And let's understand that in this case we had an equity IRR growth rate in our money of 8.71, and then we showed how that works with reinvestment of the dividends and all that. And then instead of doing all my fancy crap that I'm so thinking about doing, we say, no, the buying company has an IRR. That's the cost of capital for the buyer. Don't put that re-leveraging and crap about beta. Don't destroy all of project finance analysis by stuffing the unlevered, and it just destroys everything. It will increase the cost of capital. It will have major implications for the whole world. So we say this company, after 4 years, here's a few of our cash flows. After 4 years of cash flow, we see if our marriage is really working, and then we value the future cash flows, just NPV, and we value those future cash flows, and maybe you can argue whether that's really even appropriate, because maybe the risk is even going down a little bit later on, okay? That's how much we pay for this asset, this beautiful, boring, incredibly boring asset that we love if we're an insurance company or a whole bunch of other companies who can either invest this or kind of a risk-free, and it's very, very close. Okay, there's a little bit of bumps up and down, but if we're really confident, we get it close to the risk-free, certainly to a debt rate. Certainly to that. If we've got inflation protection in here, we can argue it's got more value than the value of debt. That's actually a really important point that we'll get to later. So that's the value of the asset in year 4. At the end of year 4, at the very, very, very end of year 4. And now, before the sale, we had to make our big investment, and then we get some money. We get some of this equity return, and we get this return for this year because this was based on the next year. And then we get our total cash flow, and we compute our IRR. Oh, that's the upside. Even if we put a 7% discount rate, if we're making 8.71, now of course if we put 9%, this whole thing doesn't work. But if we put 8%, 7%, we don't know exactly what our upside will be, but we have upside. Now if you put in something like 10% and it looks like you have downside, well, you just don't sell the asset then. Okay, you just hold the asset and get your 8.71% return. So this is my argument. You have an option to sell that you don't have to exercise, and we'll see that's almost the same thing with the refinancing. Okay, somebody could say, no, somebody could get a little bit theoretical and say, no, the value of the asset really went down, or you don't refinance. Well, you're putting, especially on the refinance, you're putting the value on the back to the bank. So that's our, now I've just got a couple of more things to talk about, okay? There's our redefinition again. I just want to talk about project finance diagrams, because now we're going to move from what I'm sorry, when I do these classes, I try to put a little survey. Do you want to learn about the theory of project finance? And I say, you're not allowed to say no. You are not allowed to say no for that. You need to understand this, have this theoretical foundation to get going. So let's talk about the diagrams. And the diagrams are supposed to, for me, illustrate the risks. What do we want to talk about in project finance? Imagine we're making some kind of investor or presentation to the lenders or presentation to our own management. What do we want to show? We want to show a picture. Now, here's what any project has. It has different volume risk and quantity risk. And again, I did this horrible class over COVID, and I didn't start with the theory because I thought, oh no, everybody wants to look at the practical crap. All different kind of projects can have price risk and volume risk. Sometimes the price is fixed with a contract, even a forward contract. Sometimes the volume is fixed with some sort of supply contract. So you could potentially have almost no revenue risk or risks from volumes and or risks from prices. Okay, that's like any investment. And again, project finance should not be limited to just kind of some really, really old-fashioned, that you would call it availability projects where everything is fixed. No. So here is my idea. We had that really simple diagram here, which might be one of the best, because we just have some CapEx, OpEx, and we go around the bend and go around the bend and get there. My suggestion is when you make your, and now we're going to turn to some of the case studies and really work on some of these, okay? I want to see the risks. I want to see if we have price risk or volume risk. I want to start with where the money is coming from. Our project, if we don't have any money coming into our project, we have nothing. So we need to put this in and write some stuff on the side about where the risks are and what the minimum kind of criteria is and everything else. And then, if it works, we go and sign a EPC contract, and we have to pay money out. So the red line goes out, and you put the contract here, and you put the quality of the contract right here, and then you put the off-taker right here, which is the person who signed this contract between the red, what did we call this? What was that silly term? I can't remember. Economically separable, whatever. Oh my God! And I put triple B minus here, which we'll come back to later on as kind of the credit quality of this entity. Okay, so we pay money out. As our project begins operating, we pay it out, and this operation and maintenance contract can have all sorts of incentives and something called liquidated damages, and we could even write what these things are and whether that's too risky or whether this liquidated damage covers this, which is supposed to do, that's this thing called back-to-back contracts, but we write all sorts of notes in here to really make a picture and describe the contract, which is my argument for a project finance model as well. And then if everything works, we can go to our lenders, which are a little bit different than the rest of them, because our lenders give us money and then want money back, just like any investors. And we want to see what kind of criteria for the DSCR they have, what kind of debt to capital, and some other notes about the bankers. And then we have the sponsors, and they do the same thing. They put money into the project and want dividends back. And that's that diagram with some description of the contracts, with descriptions of the off-takers is what we want to do. Then you go to Harvard, and here's the diagram they have. And they don't start with the money. They don't even talk about money being out. They just talk about output, e.g. power supply. They don't put they don't put a separate thing that allows you to differentiate the off-taker and the contract itself. And they start with the equity, okay, 3 sponsors, whatever, and debt, bank, syndicate, good, okay, whatever. And then they put a little thing for the host government. That's okay. You can put some other stuff in. But I hope you see, this does not, you need a real picture of the money flow. It's like that Nixon thing and the Bernstein and whatever he was, oh God, okay. Follow the money, okay? This one's a little bit interesting because they put a ring fence. Oh, it's cool. They put a ring fence around this. Again, it's the same problems, labor, whatever that means. And you're putting it in, you're actually paying money out, and you don't have anything about liquidated damages or a construction contract. That's the EPC contract. Equipment contract, different. Oh, my God. But they do have this ring fence suggesting the financial wherewithal, the equity sponsors could be Enron. This could be an Enron project that went bankrupt. When Enron went bankrupt, it continued because all these contracts are inside the fence. So that's kind of good. Maybe, we could have put a ring fence around there, but it would have been kind of messy, right? And I would have had to. Oh, it's almost like this. You could have put a line down here, and everything above the line is ring fenced, and below we don't care about who the banks are. If they've lent the money, fine. That's whether the bank is going to be Lehman Brothers, Woodward and Bernstein. Fuck, screw it. My degradation is so much. Okay, and here's finally, before we get into the case studies. It's the same kind of thing I talk about so much. If you think, we've got boilerplate contracts, we're going to take this contract, use the same idea here, use the same idea here. We have to have this contract. We have to have this. We have to have this. Oh, God, would life be horrible? Oh, we have to go to ChatGPT and stick it in there and see let it write a contract for us. Oh. Maybe your life will be like that, but I hope you say, no, let's think about that mean reversion. Let's think about what the bank is really doing. Let's think about why this should be financeable or not. Let's think about how much volatility we have in cash flows, even though we're not going to use it directly. Let's think about what DSCR we really need. And we put all of these together in a diagram, and that's the essence. That's really project finance. And isn't it cool? Isn't it kind of so much better than running a DCF model and putting a terminal value assumption based on the WACC minus the cost of capital? What a joke. Okay, that's enough for part 2. I'm going to go through each of these parts of this video, I think, this analysis.